Hello everyone. Let's jump into chapter 13, talk about budgeting. Now this is a concept that is taught in our Accounting 160 course, and so you've probably seen all of these pieces of the budget. So we're going to try to go through this and focus on the things that may be new or different than what you already have learned about budgeting. Okay? So remember that this is about our management control. So one of the ways that we align the goals of the organization with the goals of the individual employees and managers is we build budgets. And budgets are literally the way of taking and putting finances or dollars and cents on our goals. So if we have goals to reach certain level of sales or certain quality assurance areas, or we want to beat our competitor or any of those types of things, the budget is where we put the dollars and the resources together that we need to reach those goals, okay, and to be able to bring about our plans. So it can be very detailed in certain cases. Obviously, it also needs to fit a big overall picture of the organization. Okay? So if this is going to help us reach our goals, we can't really build a budget until we know what the organizational goals are. Then we don't have a long-term profit plan. And what we're going to focus here is really on this short-term, next 12 months. What are we going to do step by step, pieces, dollars, measured in dollars and cents to reach those goals and ultimately our long-range profit plan, okay? So sometimes referred to as the master budget, static budget, budget plan, typically has one level of sales that we're looking at. We'll talk about being flexible in a later chapter in our goals, but this is right here a static budget, meaning this is what we plan on making and this is what we're going to use to compare against what we actually have happen so that we can see how we did. So this is why it's brought up here in this evaluation, because while budgets are incredibly important for planning purposes, make sure we have the resources, they also have an important evaluation role in that we can compare what actually happens to our budget. So just want to mention one thing from this slide, participative budgeting, the idea that we need input from even, not just, this can't be top-down budgeting, meaning just the head honchos come up with the numbers and push it down and say this is what we're going to accomplish. If you really want buy-in from the entire organization, then there needs to be a broader say in how we're going to reach the goals. Perhaps the goals are set by head honchos without a lot of input sometimes, but how we reach them, we really should take some time, and it's going to cause it to take more time. The process is going to be more involved. But when we get to the point where we have a budget that people can believe in, they're much more likely for that to be their goal too and to have motivation to actually reach it. Okay? So this process starts with forecasting sales. How are we going to do that? We're going to talk to our sales staff. We're going to do some market research. We're going to bring in maybe outside experts. Okay? We're going to look at trends. What's the increase been over the last 3 years? Okay, we're going to look at economics, what inflation is, what unemployment is, what the price of various inputs are in the economy. Those all have a basis on what we think we can sell. Talk to our customers. What's their outlook on the economy and on things that are going on in the world? Okay, so all of those inform our sales staff, forecasting, okay? So here we've estimated 240,000 units multiplied by the price per unit gets our total sales revenue. Pretty straightforward. Of course, 240,000 units. And of course, the price influences the volume, right? In theory, if we lower our price, we'll sell more. If we raise our price, we'll sell less. Okay, so that has a bearing. So we're looking at two pieces that are related and have a lot of outside influences on them. And of course, this is if we have one product, right? In real life, nobody has just one product. We have to do this for each of our products. If we're really serious about building this, okay, knowing what to produce, we need to do an estimate of each product. So we have our sales. We know what we want to sell. How about what do we need to produce? Okay, there's our basic inventory formula. We kind of need to just get that in our heads, memorize it, if you will. Beginning balance plus what comes in minus, okay, goes out equals ending balance. Okay, so if we rearrange that, okay, we say our units in beginning inventory plus what we need to produce minus what we're going to sell, that's what we're going to out, equals our units in ending inventory. Okay, all right, so that is the specific to our production and inventory way of giving our inventory formula. Now, for our budget purposes, okay, we're going to do budgeted sales plus our desired units in ending inventory. What do we expect at the end of the accounting period minus what we already have at the beginning equals our required production. So there's our mathematical, okay. Why do we want some at the ending of inventory? Because we don't want to be zero when we start the new month or new year or new quarter, whatever time period we're looking at. So there's always, unless we're going with a just-in-time zero inventory type of scenario, there's going to be some left over that we'll to use to start the next accounting period. Here it is in a spreadsheet format, okay? So now we know how many units we're going to produce, okay? That's very important for our production department. So that's going to be then turned around. We're going to use that. Remember, we haven't done anything with this production in dollars yet. That's all in units to figure out the direct materials, direct labor, and manufacturing overhead for that production. So we're going to make 250,000. So how much direct materials do we need? How much direct labor do we need? How much manufacturing overhead do we need? Okay, so we start to break it down. You've got two different types of material. All right, our output needs 3 yards of fabric and 2 pounds of metal. And so we have a beginning of each of those and an ending and a cost per yard or pound depending on the situation. Okay? So we're going to produce 250,000, right? Each of them needs 3 yards of fabric. We want to have 15,000 left over at the end of the accounting period to start next month. We've already got 10 to start this accounting period. So we subtract that and we get 755,000 yards. Do the same thing with our metal, except we multiply by 2, right? Because we need only 2 pounds of metal for that. We have 1,000, we minus 1,000, so that kind of wipes itself out. And we need to purchase, okay, 500,000 pounds. So we need to buy 755,000 yards and it's 500,000 pounds. So then we're given what it costs per pound and per yard. We just simply multiply that. Now we've converted it to dollars. Now we have dollars that we need to spend, okay, that we will need for things like cash flow, right? That's how much money we need. So we've converted how many piles of stuff we need to how many dollars we actually need to buy and pay for, okay? And then we can add them together if we want a total budget for all the direct materials. Direct labor, simpler because you have no leftover, no beginning, no ending inventory. Okay, you just need to spend 0.25 hours per unit to be produced. You know how your units are produced from our production budget. Okay, multiply that out. Okay, and then multiply, you need 62,500. That's great to know how many people you have, make sure you got enough people hired, that sort of thing. And then we're going to pay them $24 an hour. So now we have converted that again to dollars to measure how much cash might be needed. Okay. Breaking our overhead, usually we're looking at it and in a budget sense, because we've spent so much time talking about variable versus fixed, makes sense that if we're going to build a budget as to what's going to happen in the future, we look at the variable separate from the fixed. Okay. And they've kind of lumped a bunch of things together. Most of the time, we probably list each of those fixed overhead separately, kind of like we did with a variable. Notice that variable tends to be stated in a per unit, right? Okay, indirect materials, materials handling, other indirect labor per unit, because it's going to go up and down based on how many units we produce. So, putting that all together, we've got our direct materials, purchases, ending inventory. We got our direct materials cost, direct labor, manufacturing. So we've done one inventory formula, if you will. Then that leads us to the direct materials costs. Add to that direct labor, manufacturing overhead. Okay, we had nothing in work in process. No beginning work in process. So all the cost of goods manufactured goes right down here. There's no change in work in process. If there had been a work in process beginning and ending, we would have add the beginning, okay, and subtract the ending, right, to get our cost of goods manufactured. We then add beginning finished goods and subtract our ending finished goods to the cost of goods sold. That's ultimately going to go on the balance sheet, the income statement. So looking at the marketing administrative costs, we figured out cost of goods sold, right? That's part of the income statement. You know what our sales are from the sales budget. Okay, now this marketing administrative costs, we've got variable and fixed. That makes sense to break those two. We got administrative that they treated all as fixed, making them relatively easy in terms of how much each year. Okay, we were doing this on a yearly basis. You've got them, and how much detail depends on the organization and how much what you want to track. Because remember, we want to look back and see how we did compared to this. So if you want to make comparisons, you need to have your detail match what you want, the detail you want for comparison purposes. So your income statement has your sales volume from your sales budget, cost of goods sold from their earlier example. Okay, our marketing and administrative costs from that budget. Subtract that out. Taxes usually not a big issue, but you can figure it out if you want. And then you got your profit, your net income. Perhaps more important, okay, for a lot of companies is the cash budget, okay? So now we're looking at how much cash is coming in or planned to come in, how much is going out, to make sure that we're not going to run out, that we're not going to have what we need, all right, to pay our bills and end up with a real cash crunch, you might say. So where do our cash receipts come from? Most of the time, the biggest one, of course, is collection of accounts receivable. That's what we want to. That's what we're counting on. There's sales and cash sales, occasionally sales of assets, maybe occasionally borrowing, issuing stock, but those are not what we want to plan on all the time. Usually, that's a response to not having enough of the regular cash receipts. And then our cash disbursements come from buying stuff, manufacturing costs, our employees, paying back loans. Now that is something we can count on, right? That's going to be every month, every quarter. Acquisition of new assets is typically a longer term budget issue, but that may show up in our individual cash for a particular time period. Again, probably not paying income taxes until end of the year on a set schedule, and dividends may be if that's a thing that we need to make sure we forget. Don't forget, cash budgets, and especially the expenditures amount going out, you have to be careful of one-time items. Okay, we tend to focus on the things that happen every month or things, some of that stuff. If we break our budget down into month or quarters, make sure that you don't leave off things that happen maybe just once a year, but could be significant amount of cash and could cause us to be short that particular time of the year. So, start with the beginning cash, collect on accounts. Collection on employee loans would seem to be quite a large amount for any company that I wouldn't expect. But this would be the big one. You see that's almost $7 million. Okay, by far most of the collections there. Payments for accounts payable, direct labor, manufacturing overhead. Where's that coming from? Our earlier budgets, right? Where we developed what do we need to make our product. Remember, direct labor and how much we pay for it is going to be dependent on what we're producing, not on what we're selling. All right? Because we may be building up inventory or not, but the people are getting paid based on them coming to work and producing. All right? And we tend to not have much of a lag, meaning we have to pay those people right away. All right, and then there's some of the others that were mentioned there. That again would be this acquisition of new assets would be something we definitely plan long term for, but would not be the ordinary thing we would think about. Now, when we think about collecting from our customers, we should realize that, especially if we're selling to other businesses, we're not going to sell something and get the cash immediately. There's going to be a time lag, and therefore we must plan that in our cash budget. So for instance, in this situation, we're going to collect 20% of the sales in the current month, 75% from last month, and then we're offering a 2% discount, and there are some part that we're not going to collect at all. And that we're probably going to estimate a little high just in case. So if you think about the $500,000 for January sales, you're going to collect 20% of that in January. You're going to collect another 75% of it in February. You're never going to see the 2%, right? Okay? And you're never going to see the 3%. So basically 5%, you're never going to see. You're only going to collect 95%, 20% in the current month and 75%. Now, when we did budgeting in Accounting 160, we didn't deal with that bad debt or discounts. Okay, so that's a new twist to calculating how much we're going to receive. Okay, so example of how you might do that. Okay, your $540,000 is accounts receivable from the previous year, right? Okay, and then your sales. Remember that $500,000 is January sales. We're going to collect $100,000 of that in January. So together, between collecting December's sales and that are now that it's January, and January sales is going to get $640,000. That other, okay, 75% is going to be collected in February. All right, plus 20% of February sales. Remember the 5% that is going to be, bad debt or discount, we never see at all. Okay, and same thing with March sales. Okay, in March we're going to collect the other 75% of February and 20% of March. total them up, and total across for the quarter if that is what you're trying to picture. Okay. Now the same thing happens on the cash disbursement side. Pay 50% in the current month, 50% next month, and then you're going to take a discount, let's say. All right, making it assume that we're going to take it on all of our purchases. Okay, so the $120,000 of January purchases, we're going to pay $60,000 of it in January. Okay, the other 48% in February, and then 2% we're never gonna pay. So this is how that might play out. You pay all your accounts payable, and then 20% of your January or 50% of January purchases, and then you can put your other cash payments, because we're focused on the cash disbursements for purchasing of things on credit, and then $57,000. So this too doesn't add up to the sales, right? Because of the 2% discount. This doesn't add up to the $200,000, right? That are purchases, I should say, that we purchased because of the discount. That's the difference, okay? When there is a discount, you're never going to see some part of it. So that is key. You get both the cash inflows and the cash outflows. Cash outflows tend to be much more complex in that there are more places that you're spending the cash. Typically, most, if not all, of your cash inflow is from sales to customers, which may be a little bit complicated in terms that it's lots of different customers, but in terms of sources, you usually treat it as one source. So finally, you get to a point where you're ready to do a balance sheet. Okay, this is kind of one way to look at the budget year. Okay, you know what you're going to start with. Okay, and you know what the changes are from all of the other budgets to get your ending. I find it actually easier to try to figure out what your ending is going to be based on the other budgets. So I find that this is a good way to tell if you missed anything or how you would apply things. Not giving you a whole lot of new information. Here's the liability side, same process, okay? Just to think about it, accounts payable. Okay, if you are thinking about in terms of what you still need to pay, right? What's payable? Think about the cash budget, cash payments budget. See how you've paid for all of February, and you've paid half of March. Okay, the other half is still in accounts payable. Now this is going all the way to December, so it doesn't match up, but that's how you would get what accounts payable was. What is that half on December 31st? Okay, that you still owe. What is that half of your accounts receivable, of sales, or whatever percentage, 75% or whatever, that you haven't collected? That's how to think about the balance sheet. So this is a graphic of it, okay, of how you might do it in a manufacturing terms. Okay, here's the difference if you use a retail organization, right? You don't have to worry about production. You're just buying things. Everything's just purchased. So you treat it basically as raw materials, okay? Simpler, all right? You don't have to worry about overhead, direct labor, those types of things, okay? Service organizations, you may have a more emphasis on that labor if it's a service organization. So this is a situation where we've got some very expensive units. We estimate we're going to sell 300 of them. We want to have 5 at the end, not a lot, right? And we have 2 to start with, okay? So we have to to buy 303 of them. We don't have to make them. We don't have to hire people to make them. We just have to buy them, get them in, put them on the shelves or display them, and that's 303 of them. Okay, estimated cost per unit $17.25. Now let's be real honest. This is not a very helpful budget in the sense that because the inventory is such a small percentage and a very small change compared to sales. You could have just said 300 and you would have been close enough for a budget purposes for the most part. But that's how you would do it. And in most merchandise places, you have a lot more stuff on the shelf, right? A lot more things displayed than 2 units or 3 or 4 units. All right. Cost of services is important if you're a service organization. All right. But again, process is basically same thing. Still looking at that cash budget. What do we have to pay? Remember that your people, especially in a service organization where people might work on a project for 3 or 4 or 5 months before we actually get to bill the customer, that becomes very important for a budget purpose. We got to pay those people each week or every 2 weeks for that whole time and then bill the customer at the end. And so we better build that into our budget so that we know that we have the resources to pay them until it's time to send the bill. And that's important for things like engineering or other things where you work on a project and people can get paid really good money while they work on it, but you don't get the bill until you're completed. So, if these budgets are going to be used to evaluate people, then of course they have some incentive to, finagle their numbers to either make themselves look better, to change the budget to make it lower so it's easier to meet, to change the numbers so that they meet the budget, or all those things, of course. All right. And we want to put in place the internal controls so that they can't just unilaterally change things to take away the temptation. So basically want people to be honest and transparent on this, and it usually requires a little bit of extra effort on our behalf to make sure that is the case. So how do you work with the fact that you don't know what the future is going to bring? Okay, so most places will build multiple budgets, okay, to look at a range of scenarios. What happens if our sales are here? What happens if our costs are here? Can we run it 2 or 3 times? Once we build the formulas and spreadsheets and things like that, and most budgeting is still done with spreadsheets. There are budget software programs, but they don't do a whole lot more than what a spreadsheet would do. But occasionally there's ones that will spend a decent amount of money, will allow you to be able to quickly make adjustments like, what if labor costs are 10% higher? But typically it's easy to see in a spreadsheet. You go in there and create different scenarios. Make copies of the whole thing. Don't just change it all in one. If you're building this in real life, build it, copy it, redo it, change the assumptions, copy it again, change the assumptions, so that you get something that looks kind of like this, although I would never stick this many options all on one page, okay? With different levels of revenue, different costs, okay, various levels of marketing, administrative, and profit. And then, of course, if that's going to be used for evaluation, then you have to decide which one is the valuation, and we'll talk about that a little bit more when we talk about flexible budgets later. But this gives you an idea of this. We know this is an estimate. We know this. We don't know for sure. We have some ideas, but we're not going to get exact. And so it's good to look at multiple possibilities.